Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get sort of value or entertainment out of these videos, I'll ask that you hit thumbs up and subscribe. Questions, comments, put those below. As always, going to give a brief overview of the financial markets that was this past week and then go into a little bit more detail on a couple things. Obviously, everything all pertains and relates back to real estate to some degree. First and foremost, you may have noticed the calendar is no longer with us. Rest in peace. It was reached the end of its life cycle. There was obviously it's taken a lot of punches over the last few weeks from in the comment section. So the calendar is no longer with us. Soon to be replaced. But anyways, diving into the financial markets, it was obviously a very volatile week. Obviously, the stock market taking some punches, bond yields ripping higher. That obviously has an impact. Canada 5-year bond hitting a 5-year high or 7.5-year high, which of course pushes your mortgage borrowing rates higher. So we've seen the 5-year fixed get pushed higher by several of the big banks. The stress test sort of benchmark rate looks like it's going to push higher probably next week. There's a couple banks that have pushed not only their 5-year fixed, but their 5-year posted rate. And so as soon as a couple banks follow along with that, it basically sets the new qualifying benchmark slightly higher. Obviously not good for those in the housing market maybe looking to sell. We're obviously seeing incredibly weak sales. Mortgage growth is anemic. And of course, that stress test continues to sort of weigh down credit growth. We're seeing basically loan growth from the big banks get cut down from around 6 and 7% back in 2016. Year-over-year loan growth down to around 3.5% here, as you can see from National Bank. They posted this the other day. So that loan growth is quite depressed right now. And they're expecting that to prolong over the next couple of years. That's at least in their forecast. Unless, of course, they can sort of change the regulatory framework. But by all accounts, it looks like OSFI is actually set to get even tighter on lending. They're actually looking at eliminating equity type loans. Basically, a lot of the banks won't necessarily verify income if you have a certain percentage of equity in a property. If you have 35% equity in a property, a lot of them won't even go through the proper due diligence of verifying income. So they'll basically just loan on the fact that you have that certain amount of equity in your property. So OSFI is looking at removing that. I think if they remove that, it's going to be significant. But again, all of the growth right now is happening in those private mortgage investment corporations. Obviously, those are all 1-year bullet loans. So it actually in my opinion, puts the financial system in a more vulnerable position with 1-year bullet loans. Obviously, loan to values can deteriorate in 1 year. Interest rates certainly can reset much higher in 1 year, etc. But that's what's happening right now, and that is actually what happened in the States in the late part of sort of 2006, 2007. The bigger banks sort of pulled back, and then you had a lot of the private guys expediting much of the growth. So nothing is new there. This is typical of sort of a late cycle. Getting into some of that stuff, there's been some questions or comments on the state of the market. Looking again at that, I would say, I did some research on the months of inventory, which is a pretty good baseline for the overall health and stability of the market. So if you look at it, generally anything under 4 months of inventory is considered a seller's market. 4 to 6 is a balanced market, and anything above 6 months of inventory is considered a buyer's market and downwards pressure on prices. So if we look at Greater Vancouver as a whole and the condo market, despite sales being low, the inventory is still quite tight. And so if you look particularly for condos that are priced under $600,000, the MOI, the months of inventory, is at 3 months of inventory, so it's still very low. Things are still moving quite quickly in that market. But as soon as you get over that 600K threshold, the MOI basically jumps to 8.6 to be exact. So you can see the noticeable slowdown in the 2-bedroom segment, 3-bedroom condos, etc. Really, it's just those entry-level 1-bedrooms are still moving fairly well. And then you go into the detached space. Even the detached entry-level homes have a months of inventory of 8, and as soon as you get over $2 million, the months of inventory jumps to a whopping 16 months of inventory, which is just absolutely insane. And so that's something that we'll continue to watch. Again, it's not necessarily that new listings need to explode higher. Sometimes it's just a matter of sales stagnating and allowing inventory to accumulate, that puts the significant downwards pressure on prices. So again, sort of the last, I guess, somewhat of a stronghold is that one bedroom sub 600K. But again, you have to look in the sort of financial context of a real estate market. Generally, as we look at real estate cycles or financial cycles for that matter, generally in your early expansionary phase, it's a few smart people sort of figure it out, and then you have sort of your institutional money come in to see that it's better value as you're in the upswing. And then really at the peak top of the cycle, you have sort of your, generally is a less sophisticated buyer that's entering into the market. Big money, let's call it what it is. You don't have big financial money kicking around into one bedroom condos right now. So it's a much different buyer and it's a much different market psychology today that's keeping those one bedrooms afloat. And I've also talked about sort of the markets, what is happening, obviously with loan growth at basically mortgage credit growth at an 18-year low. We're seeing the auto sales rip lower by dropping 7%. These are all signs of late stages deleveraging. So we're going to continue to keep an eye on that. But as a result, we were seeing housing starts really start to fall off. CMHC released the latest numbers for September. The trend line, or the seasonally adjusted annual rate, has absolutely plummeted for BC and Vancouver, and honestly a lot of Canada. Now those numbers can fluctuate a little bit, so it's a little bit early to read into, but even when I released the actual numbers, which is not seasonally adjusted, just using a 12-month rolling average, you can still see that Vancouver has peaked and has begun rolling over. And it's interesting to see now the debates and the uproar from the development community, not only publishing articles online, but everybody saying, how terrible it is that housing starts are now rolling over, that, things are going to get worse, we're not building enough supply. As if they're somehow surprised that housing starts are rolling over. I just don't understand how anybody can be surprised that housing starts are rolling over. We've had peak housing starts, we've had peak housing under construction. To say that we haven't been building is completely false. It's natural part of a cycle that as housing markets slow down, housing starts simultaneously will roll over, and that's generally a leading indicator of the future economic growth. So you're going to have people laid off in the construction sector. The industry, real estate is slower. That results into slower wage growth. You'll probably see population growth curtail back, as I've talked about in my previous video on cycles. It's a couple weeks back. Go watch that. But what do we think is going to happen was interest rates move higher. You have the 5-year bond hitting 7.5-year high. That people are all of a sudden surprised that housing starts are rolling over. No developer is going to build for free, and if they see risk, they pull off, and that's just general of a market cycle. So, but now obviously they're complaining and saying, it's the government's fault. It has nothing to do with the government. This has everything to do with tightening monetary conditionings. Liquidity basically getting squeezed across the world. So. It was inevitable, regardless of whatever government was in power. So, it's interesting just listening to a Macro Voices podcast with, I believe it was Keith Dickert of Ice Cap Management, asset management in Canada. But obviously they have a global framework. And this is something that I've emphasized in these videos, is that generally people continue to look at Vancouver or Toronto real estate, or even Canadian real estate more broadly. They're looking at it from an isolated context. They're looking at it as if it's some sort of micro isolation. But the reality of it is Canadian real estate, and Vancouver and Toronto and even Calgary and all these cities, these are all impacted by global liquidity conditions, global factors. So whatever is happening, it has really very little to do with your municipal zoning bylaws. It has much more to do with what's happening in the global bond market. And so it's funny because listening to that Macro Voices podcast, Keith Dickert, he goes, people always ask me, hey Keith, what do you think is going to be maybe a potential tipping point for Canadian real estate? What is maybe that catalyst that really starts to push things down, like that next leg down? And he says, well, keep an eye on the the Italian bond market. And obviously he says, yeah, and then people just kind of looked at me funny, like, Keith, what are you talking about? Why are you talking about Italian bonds? I'm asking you about Canadian real estate. But again, these things are all correlated. Like whatever's happening to Italian bond, like if those bond yields start to blow out, that has a major impact across the ECB. And of course, the European Central Bank has been discussing about, removing quantitative easing. These guys have essentially eliminated the entire bond market in Europe. So at a time when their spreads are starting to blow, you got to watch that. Now we're starting to see the U.S. 10-year pop almost to 3.25. This has major implications on assets that are particularly sensitive to higher interest rates. Real estate is very, very sensitive to higher interest rates. There's a lot of leverage involved, so it's very sensitive. And same with auto sales. There's no reason why it's very obvious as to why real estate and auto sales are declining, not just in Canada but across much of these global markets. And so that's the same thing. We put this whole picture together, as I've talked about Toronto. Everybody's looking at Toronto, again, as this isolated phenomenon that because year-over-year numbers are up slightly, that it's somehow out of the woods, moving on. But again, if we look at some of the charts that I put together here, if you actually just look at sales historically, so this is basically a 12-month rolling average of sales in Vancouver and Toronto, you can see basically in 2008, 2012, and most recently that their sales really move in tandem. They basically have these peaks and valleys, and they're very closely correlated because they are global cities that are highly dependent on what is happening in the Canadian, or basically the lending environment across the globe, and in particular in Canada. What are those macroprudential policies that are going to impact housing markets? And so you can see that the sales historically have been very correlated. Now, if we look at basically sales for Vancouver, that 12-month rolling average, I believe the sales actually topped out in July of 2016, and then 9 months later, sales in Toronto peaked out in April of 2017. And now, simultaneously, if you take the MLS benchmark price of Vancouver and Toronto real estate, you can see how closely correlated. There actually is about a 9-month buffer or a lag in that environment. So, again, when our sales peaked out and our detached prices bottomed out, they actually had a bit of a revival in sort of the spring of 2017 before ultimately taking their next leg down, which is they're clearly in that process now. So, to suggest that Toronto is somehow going to be exempt from global macro conditions, we look at the sales again from the 12-month rolling average. Yes, you're having a slight uptick in sales, but if you still look at a 12-month rolling average in Toronto, again, this is Toronto, not the entire GTA, but if you look at Toronto, that 12-month rolling average of sales is the weakest it's been since 2008. I mean, these are terrible sales numbers. But anyways, despite that, these markets cannot be looked in isolation. What the Federal Reserve is doing, hiking interest rates, creating this US dollar squeeze, has a very broad impact on global liquidity, and that's why you're seeing housing markets, not just in Vancouver and Toronto, being particularly soft, or in Calgary and Regina, but in Seattle starting to slow down, London, Hong Kong, China, Manhattan, Denver, Colorado, Sydney, Australia, Melbourne, There's a reason why all these housing markets have all of a sudden gone quiet, and it's not because of foreign buyers taxes or changes to municipal zoning. It has much more to do with how these credit and capital markets flow. For every action, there is a reaction. So I think I'd just like to highlight how important it is to understand that we need to consider the larger picture when looking at these housing market movements. So that's kind of where we're at. We'll continue to update you and monitor the markets every week. But as I said, I think that unfortunately, it really, and this is part of my concern, because I have constant conversations with developers, and some of them very smart people, some of them have done very, very well, but also not totally comprehending sometimes the importance of these macro movements and the impact it can actually have on a more local level here. But obviously everyone's focused on municipal governments and all that sort of thing. So that's all I got for this week. Anyways, hope that helped. Otherwise, see you next week.